A mortgage can make a home feel affordable even when the full price is far beyond your bank balance. That is the useful part and the dangerous part. You do not pay for the entire house on day one. You borrow a large amount, repay it over many years, and pay interest for the privilege of using the lender's money. Understanding a mortgage means understanding what your monthly payment is really buying, what it is not buying, and how the long-term cost can quietly grow. The basic mortgage structure has three main parts. The principal is the amount you borrow. The interest is the cost charged by the lender. The term is the length of time you agree to repay the loan. If you buy a home for $300,000 and put $60,000 down, the mortgage principal starts around $240,000, before fees or other costs. From there, interest and time shape the real cost. The down payment matters because it changes both the loan size and the lender's risk. A larger down payment means you borrow less and may look safer to the lender. A smaller down payment can help someone buy sooner, but it can also increase monthly pressure and, in some places, trigger extra insurance or stricter loan terms. The size of the down payment affects the whole mortgage, not just the day you buy. Your monthly mortgage payment is not just one simple charge. It usually includes principal repayment and interest. Depending on the country and loan setup, it may also include property tax, homeowner's insurance, mortgage insurance, or escrow payments collected by the lender. This is why a buyer can be shocked when the payment they imagined is lower than the payment actually due. Amortization is the engine underneath most mortgages. In the early years, a large part of the monthly payment often goes toward interest because the loan balance is still high. A smaller part reduces the principal. Later, as the balance falls, more of each payment goes toward principal. This can surprise homeowners who pay for several years and then discover their loan balance has not fallen as quickly as expected. For example, someone may pay their mortgage every month for 3 years and assume they now own a big new piece of the house. But if the loan is early in its term, much of those payments may have gone to interest. They are building ownership, but slowly. This does not mean the mortgage is unfair. It means the schedule was designed around long-term repayment, and the early stage is interest-heavy. A fixed-rate mortgage keeps the interest rate the same for the agreed period, sometimes for the whole term depending on the market. That gives predictability. A variable or adjustable rate mortgage can change when benchmark rates change. It may start cheaper, but the payment can rise later. The right choice depends on risk tolerance, income stability, and how long the buyer expects to keep the property. Interest rate changes can transform affordability. The house price may be the same, the down payment may be the same, and the buyer's salary may be the same. But if the mortgage rate rises, the monthly payment can jump. This is why buyers who shop only by home price can misunderstand the market. The real affordability question is home price plus financing cost. Lenders usually check whether the borrower can handle the payment. They may look at income, debts, credit history, employment, savings, property value, and loan-to-value ratio. Loan-to-value compares the loan amount to the property value. If the borrower wants to borrow a very high percentage of the home's value, the lender sees less cushion if something goes wrong. Pre-approval can help a buyer understand the likely borrowing range, but it is not a promise that every property will work. The property itself still matters. If the appraisal comes in lower than the purchase price, the lender may not finance the full expected amount. A buyer could then need more cash, a renegotiated price, or a different home. Closing costs are another place buyers get surprised. Beyond the down payment, there may be lender fees, valuation fees, legal fees, registration charges, taxes, insurance payments, or other transaction costs depending on the market. A buyer who saves only for the down payment may reach the finish line and realize they still need extra cash to complete the purchase. Escrow is used in some mortgage systems to collect money for expenses like property taxes and insurance along with the monthly payment. Instead of the homeowner paying those bills separately, the lender collects a portion each month and pays them when due. This can make budgeting easier, but it also means the monthly payment can change if tax or insurance costs rise. Equity is the part of the home you actually own after accounting for debt. If your property is worth $400,000 and your mortgage balance is $300,000, your equity is roughly $100,000 before selling costs or taxes. Equity can grow when you repay principal or when the property value rises. It can shrink if property values fall or if you borrow against the home. Refinancing means replacing an existing mortgage with a new one, often to get a lower rate, change the term, switch loan type, or access equity. It can save money, but not automatically. There may be fees, new terms, and a longer repayment period. A lower monthly payment can look good while increasing the total time spent in debt. Early repayment can reduce total interest because the balance falls faster. But some mortgages have prepayment limits or penalties. The borrower needs to know the rules before making extra payments. Even a small extra principal payment each month can shorten the loan in some cases, but only if the payment is applied correctly to principal rather than future scheduled payments. The biggest affordability mistake is buying at the edge of approval. A lender may approve a payment, but that does not mean the payment fits your actual life. Repairs, furniture, moving costs, school fees, transport, job changes, and emergencies do not disappear after closing. A mortgage that looks manageable on paper can feel suffocating when the real household budget arrives. A realistic buyer should stress test the payment. What happens if income drops for 3 months? What if maintenance costs more than expected? What if an adjustable rate rises? What if property taxes or insurance increase? A mortgage is not only a purchase tool. It is a long commitment that needs breathing room. Mortgages also affect behavior. Because the payment arrives every month, it can shape career choices, spending habits, risk tolerance, and family decisions. A comfortable mortgage can create stability. An overstretched mortgage can turn a dream home into a source of constant pressure. The emotional cost matters alongside the financial cost. The clean way to understand a mortgage is this. You are buying a house with a mix of your money and borrowed money. The borrowed part has rules, time, interest, fees, and risk. The monthly payment is not the whole story. The true cost includes the loan structure, the rate, the term, closing costs, taxes, insurance, repairs, and the flexibility left in your life after paying. A mortgage is not good or bad by itself. Used carefully, it lets people own homes without waiting decades to save the full price. Used carelessly, it can lock a household into years of financial stress. The key is to look beyond the purchase price and ask the better question. After the down payment, interest, fees, monthly costs, and risks, does this home still make sense for real life?